Right. Good evening. Let's get started for today's sharing over here. So for today's sharing, we'll be focusing on the topic on the four trading pillars, okay, specifically in the currency and FX market. Now, if today you're very new to trading the currency and FX market, this sharing here is especially designed for you to give you kind of like a holistic understanding and I would say more or less the roadmap in which you want to eventually have as you approach the currency market itself. Okay. Now, as the name suggests here, four trading pillars, essentially what it means is that these are the four aspects. If you're trading the FX and currency market, you definitely need to be aware. And more importantly, if you're able to master these four trading pillars, you actually see tremendous improvement in not only your understanding of the FX market, but of course, in terms of this, it will help you to craft your trading plan and strategy moving forward here as well. Okay, so what's the four trading pillars? Essentially, over here, I'm actually using the framework of a construction of a building. Okay, so you can see it right at the bottom. It's the foundation, right? And in terms of trading foundation here, there are quite a bit that you need to take note of. Of course, we won't have the time to really go into this aspect for today, but I just want to highlight and stress upon the importance of trading foundation, okay, which includes your mindset, your expectation towards the financial market, towards trading, okay, how you manage your psychology as well as your mentality, as you are trading the market itself. Okay. So this is very important. Of course, it's not an overnight thing, but this aspect here, you need to be constantly developing. Okay, you need to always put in the work, and it's just like any muscle memory, right? You might not see the result or the outcome in a very short period of time, but you just need to have faith that the whole process of developing your mindset, your psychology is so important. Okay, and eventually you realize that a major contribution of your success in trading will eventually come from the mindset as well as the psychology that you're gonna be having. Okay, so do take note of that. This is a constant growth thing as a trader, especially on the foundation aspect. Now, that's going to be very, very important because if today you can have multiple strategies, you can have multiple understanding of the market. I can provide you with a very profitable, consistently giving you profits strategy. But if your mindset, your psychology, your mentality is not there, okay, that strategy won't be profitable for you anyway. Okay, so that's the importance of it. Okay, so I just want to stress upon that. Now, after that, once you establish, okay, the trading foundation is where you're going to constantly put in the work. That's where the four pillars come in. Okay, and those four pillars here, of course, include macro analysis, sentiment analysis, technical analysis, and risk management, as you can see. Okay, now this is the part where I always tell traders, right, especially if you're very new, of course you don't need to like immediately in a very short period of time go and master all these four pillars, but eventually in your journey you want to at least get to know each and every of this, right, so that you have a better understanding and comprehensive view of what the FX market really is. Now, there are some traders who, do not use fundamental, for example, or do not use technical analysis at all to trade, and they can be very profitable. Okay, so I just want you to be aware that when I mentioned that these four pillars are important, it does not necessarily mean that you need to always utilize them in your trading. Okay, but it's very important that you need to first understand and know what they are. Then only you make that choice of whether you want to include it into your plan, into your strategy. Okay, I always say this, right? If today you only know one thing, okay, I mean, you only know technical analysis, for example, you do not have the power of choice. Okay, you can't choose because that's the only way that you know, and therefore you're limiting your understanding, you're limiting your approach towards the market. But if today you know all of this different methods of analysis, and from there you're at a much better position to actually make a decision as to which one fits into your style, which one is more effective at this current market environment, and therefore you would have that confidence approaching the market. Okay, so I just want you to know that, well, it's important to look at all and understand and equip yourself with different tool sets. It does not necessarily mean that you need to 100% use them all the time. Okay, so that's why this webinar, this sharing over here, is to really provide you that perspective so that you at least know, okay, this method is, what's the pro, what's the con, what's this method really about. And then once you understand it, you dive deeper into it, you acquire that new knowledge, that skill set. Okay, then only then you do make that decision as to whether you want to include this as part of a trading strategy. Okay, so you can see over here, right at the top is where we kind of like formulate the strategy. Okay, so just like building, I would say, a structure. Okay, you always start with the foundation, right? Same thing in trading, you start with the foundation, and then you start to put in the pillars, right? And then you top it up with the roof. Okay, so the process and the journey of trading is the same. Okay, first, of course, you need the right mindset, psychology, and then start to understand the different. Right, sorry about that. That's the alarm. Okay, but I was saying that it's the same thing in trading. Okay, you start off with the psychology, the foundation, and then you start to build up the pillars, the different analysis, the skill set that you're going to acquire, and then from there you formulate the strategy that fits into your style. Okay, now let's start off with the first pillar over here to share with you what macro environment is. Okay, or I would say like fundamental. Okay. Now, if you're not, if you did not study economics back then in school, a lot of people say that, well, fundamental is difficult to understand because I didn't study economics and things like that. But to be very honest, you just need to understand the fundamental top flow, and it's not that difficult, okay, to start using fundamental to understand what's happening in the FX market. Now, the fundamental top flow here, this framework is pretty straightforward. First off, you of course need to understand what the central banks are, what they do, what's their objectives, what's their KPI, right? Or we use the word mandate over here. Okay, and then from there, you need to start to understand a little bit in terms of like the various indicators. Of course, there are many different economic indicators. Not all of them are equally important. I would say you want to start off with like what's the most important one, right? Some of them you probably heard of, like NFP, CPI, Consumer Price Index, maybe FOMC meetings, etc. Right? There are many different indicators, but of course not all of them are equally important. Like NFP, unemployment rate, I think those are the important ones. Right? So the next step after understanding central bank, understanding economic indicators, is where you want to put them into a flow where it makes sense to you as a FX trader. Okay, so very simple, right? You just need to break the entire fundamental analysis process into this three component, and you're good to go. Okay, so first up, of course, we trade the major currencies, and therefore each currencies itself would have a central bank. And if you take a look at this, basically these are the 8 major central banks around the world, which you might want to be very familiar with. Okay, I think it's not that difficult because the name itself kind of tells you like which country, which currency is related to. Okay. And of course, the most important central bank as of today is going to be the Federal Reserve, because dollar itself is still the global reserve currency. Yeah. Okay. But what do central bank need to achieve, right? What's their mandates? What's their KPI? Basically, there are two. Okay. First one here is to maintain price stability, which usually ties back into like inflation rate. Okay. Of course, inflation here, if it's too low, it's not good, because then we'll be going into like what we call recession. Okay, the economy is not growing. However, if inflation is too high, that's also not good, right? Because then we'll go into like hyperinflation, okay, and people would suffer, and then the economy wouldn't do well. So one of the mandate that the central bank need to achieve is price stability, which is a healthy inflation target. And most of the time, most central banks would have a target between 2 to 3% year on year. Okay, that would be like the ideal inflation rate that central banks would wish to achieve. Okay. Now, the other KPI that they look into is the labor market, or aka employment rate. Okay, and again, this is important because labor is a very important factor into the growth of an economy. Okay, so they want to also ensure that majority of the people are being employed, and that kind of increases the productivity of the economy as well. Okay, so just understand that these are the two main KPI, right? And how do central bank tracks this KPI? Of course, they use it, they do it through the economic indicators. Okay, and that's where you need to then understand, okay, which economic indicators is the most important one that's going to reflect price stability, inflation, and which one's going to reflect like the unemployment rate, the labor market status. Okay, so what this means is that, okay, again, just now we mentioned, right, if inflation is too high, the economy is too strong, then central bank needs to do certain things to prevent hyperinflation. Okay, the opposite is true. If the economy is too weak, inflation is too weak, there's a lot of people unemployed, then central banks will also need to step in to prevent the economy from going into recession. Okay, so their role at the end of the day, if you just put it in a very layman way of understanding, is maintaining a balance in the economy. Okay, and that's what they need to do. Right. So from here, then of course, understanding they have a certain KPI, understanding that, you know, depending on which environment, they need to step in and take action. Okay. The next step over here is to understand like what are the options that the central bank can use, can do, to kind of like bring the ideal state back. Okay. So first one here is interest rates, right? And I think by now, if you're familiar with a little bit of what's happening right now, you know that the Federal Reserve, right, is actually looking to raise rates. That's the theme for 2022. Okay, and the idea over here, of course, is the central bank is able to increase rate as well as cut rate depending on which one they want to go. Okay, so if inflation is too high, then of course they need to start increasing rates. If inflation is too low, then they need to start cutting rates. Okay, that's the idea of it. The second tool that they can use is monetary policy. Okay, or more often than not, people talk about it with this term called quantitative easing, or QE in short, right? So what QE literally means is that the central bank is going to print more money and then release it into the economy so that they can kind of spur spending, right? They can encourage spending, and then spending would then lead back into a better economy. Okay, so that's what QE means. Now the opposite of QE is called tightening. Tightening is where the central bank stops or can slow down the printing of money, and therefore the money supply drops, and people then tend to spend less. Okay, so they do have generally kind of like opposite effect. Okay, the last tool that central bank have that most people might not be aware of is called language. Okay, and the idea of language over here is depending on which direction the central bank is eventually going to head towards, the chairman or the president of the central bank is able to kind of like step in and then kind of like inform the general market like what's the direction of it. Now, this is also very useful from the central bank perspective because they can actually prep up and let the market know way before what's their direction so that the market would not be, you know, put in a surprise element. Okay, so language is also pretty important because when the central bank kind of update or release a certain form of statements, the market would then start to digest that piece of information and then react accordingly. Okay, way before like they really take action, language is actually a very powerful tool. Okay, if we put that into kind of like a summary table, okay, this here kind of give you a better understanding directly. Okay, so if the economy is bad, you know, global economy is not doing well, then the central bank will need to take action, right? And what they need to do is they need to start considering lower interest rate or exercise quantitative easing, printing money. And the effect of that on the particular currency is that the currency tends to devalue and the price of that particular currency probably drop, right? So currency depreciates. The opposite is true. So if the economy is strong, then central banks would likely look to increase rate and exercise tightening, and that would have the currency tend to then appreciate, right? The price of that particular currency would tend to rally. Okay, so that's on the fundamental flow. Okay, that's on fundamental analysis. Now the second pillar over here is called sentiment. Okay, and sentiment analysis is basically understanding what's happening right now, right? What's the current market environment we are in? So market sentiment reflects the psychological state of the market. Okay, so it relates back to a little bit on the emotional aspect, right? What's the general traders and investors feeling right now? Okay, it tells us whether the market is generally bullish, bearish, euphoric, confused, or fearful. Okay, so in a way, this is important because it can guide us in understanding. Okay, if the market is in a fearful state, then what we need to take note, right? How is it going to affect certain currency, and then vice versa? If the market is in a bullish, in a euphoric, in a greedy environment, what are some of the currencies that are going to be affected? Okay, so when you understand this relationship between the current market environment versus the effect that's going to have on certain currencies, that is what we call market sentiment analysis. Okay, so some of the factors that can affect the sentiment includes, of course, like deviation from expectation, unexpected economic bombshells like the subprime mortgage, right? Falling stock market, or when the market is crashing, that will also have an effect in the sentiment. Basically, war, natural disasters. Recently, we have like pandemics, right? All this is going to have an effect in sentiment. Okay, so if we kind of summarize it a little bit, anything that can contribute to fear and uncertainty is definitely going to have an effect in the sentiment market. Okay, and the idea over here is when the market is put into a fear and uncertain environment, we have a term for that, right? And we call it a risk-off environment. Okay, so risk-off, if you think about it, it's just like a button. Okay, you can switch off and switch it on. Okay, risk-off, basically you switch the risk off. Okay, and this equal to investors and traders not wanting to take high risk, and they will rather prefer something that is of a lower risk, lower return investment, right? The opposite is true. If the market is certain, is bullish, then investors would tend to be on the risk on mode, and that means that they were willing to put their money at a higher risk asset for a much higher return. Okay, so generally, if you take a look at sentiment, we do have these two environments, either risk off or a risk on. Okay, and this table here kind of give you the effect, okay, between like what the asset, what the currencies, and during risk on, what's going to happen, what's the general effect, and during risk off, what's the general effect. Okay, so if you are looking at the FX market, you can see like dollar, yen, and CHF. They're basically what we call the safe haven currency. During a risk on environment, they tend to actually fall. Okay, and during a risk off environment, they tend to rally. Okay, and if you take a look at Aussie and New Zealand, we call this risk currencies, right, or commodity currencies. During risk on, they tend to rally, and during risk off, they tend to drop. Okay, so that's the general relationship that you can expect between the currency and the risk environment. Okay, yeah. So that's on sentiment. Okay, so you can start to see like in the market, even within currencies, there are so many factors that can affect the price. Okay, so that's why it's important for you to have that holistic understanding, so that you know, okay, right now, if the market suddenly is in a panic state, sentiment analysis takes precedence over the others. If nothing is really happening, then there's a major change in the fundamental central bank monetary policy, then okay, macro analysis takes precedence. Okay, so that's the idea why having these 4 trading pillars in your toolkit is so important. Okay, so the third one over here is technical charts. Okay, and the beauty about technical analysis is that it allows you to analyze the market and make a decision and execute a trade with a certain level of precision. Okay, fundamental and sentiment can't really give you that, but the strength of fundamental and sentiment is to give you a better understanding, so that it builds up the confidence and the conviction when you look at the market. Okay, because you understand what's exactly happening. The beauty about technical is that it allows you to have certain level of precision in your execution. Okay, so in terms of technical analysis, I just want to very quickly share with you the method that I'm primarily using right now. Okay, because when you look at charts, there's so many strategies and ways to look at it out there. Okay, if you just do a simple Google search on technical analysis, I believe you can easily find like 100 ways to analyze based on just a chart, right? You have indicators, you have different methodologies, you have Fibonacci's, you have like price action, etc., etc. Okay. So for me over here, I'm basing it on the principles of Elliott wave. Okay, where we don't really use much of an indicator, but we are looking at how the price is developing. So in over here, when I look at the chart, I kind of categorize two types of move. One is impulse, the other is correction. And impulse are basically market with strong momentum, okay, which means the price actually move off in a certain direction in a very, very strong, fast manner. Correction is basically the opposite, where there isn't much of an energy, the market is slow, it's just going sideways, right? So to illustrate that, this chart here does the best, okay? So if you take a look at it, the red color zone, they are the impulses, and the blue zone are basically the correction. Okay, I think visually you can really identify, right, the difference in momentum, the difference in the pace, the speed of how price actually move. Okay, so we can actually categorize them in impulse and correction in any particular time frame. Whether you look at the daily chart, you look at the forward chart, you look at a 15-minute chart, it's the same principle. Okay, you can start to categorize price movement is either impulse or correction. Okay, and this method starts to allow me to establish a directional bias. Okay, because when I understand the price chart in impulses and correction, essentially there are only three ways it can move, right? One is impulse correction combination, the other is an impulse combination, and the third here is impulse then a crawl combination. Now let me show you the illustration of that, and then you understand it better. Okay. So first up, when we have this kind of combination where the market price chart shows you this pattern of impulse then correction, there's a very high probability that the next move from the market is going to hit higher. So at the end of the day, technical analysis is about identifying patterns. Okay, so you need to train your eyes to recognize this pattern visually. Right, so when you see this pattern, there's a good chance the market is heading higher. If you see this pattern, of course, there's a good chance the market is then heading lower. Okay, so this is the first pattern that you might want to recognize and be familiarized with. Now, the second combination in the market you might see quite frequently is what we call a V shape. It's basically two impulses combining together, right? So it forms kind of like a V and an inverted V. When you see something like that, we often say you don't want to trade it because you don't really have a high probability direction. Okay, so this one here, not much. Now the third combination we're going to see is a crawl. Basically, it looks something like that. Okay, so initially the market is going up very fast, very strong, but starting to slow down afterwards, right? And that's where it starts to form the crawl pattern. Now, what this suggests is that the momentum, the energy to the upside is lacking, and there's a higher probability eventually it's going to be a reversal. Okay, so we then have a clear sense of direction where we want to focus. Okay, the opposite is true. So if the market starts coming down and then it starts to form a little bit of a correction, a crawl, that's why we know, okay, momentum is dying down, energy is lacking, and therefore we look for the reversal. Okay, so these are basics in terms of like the fundamentals of what really technical analysis can do. Okay, so you can see one, it tells you patterns. Number two, of course, it tells you like, okay, based on these certain patterns that have developed, which direction do you want to focus on? Okay, so that's what it can help you to do. Okay, of course, there are many different methods, as I mentioned. Okay, this is just one of them. Okay, and if today you are trying to seek out like what's the best, what's the kind of like highest accuracy in terms of technical analysis, let me just help you to cut short your learning curve. There's no such thing as the best. There's no such thing as 100% sure win or sure accurate. Okay, at the end of the day, the market is ever evolving. Okay, you don't need to have a very high precision probability of like method. Okay, so any method that can give you at least about 60% of accuracy should be good enough for you to utilize. Yeah, so I just want to, straight up let you know, if you're seeking for a holy grail, you're going to be struggling. Okay, so don't fall into that pitfall, don't fall into that trap. Now, the last aspect here is risk management. Okay, and this is all four pillars. This is like the most important element in trading. Okay, and risk management is all about managing your money, managing your risk. Okay, so in risk management aspect, of course, you can go very complex. But today we're gonna keep it simple for you to understand. At the end of the day, when you're talking about risk management, you're looking at these three elements. Okay, first you need to predefine your losses, which means that before you enter a trade or before you take a trade, you need to be very clear, like what's the amount of money that you're prepared to risk. Okay, so is it like $100? Is it $200? Is it going to be $500? Or is it like 1,000 or even more? Okay, so the idea is you need to be very clear, like what's the amount of money that you're prepared to lose or prepared to risk for the particular trade. Okay, so that's the first element. Now the second element is you need to know when to get out, right? In other words, if you're making money, you need to be clear, like, okay, that is good profits for me, let's get out, right? Because the market is never going to go one direction all the time. It's going to go up, come down, go up, come down, etc. Okay? So you need to know when to get out when you're making money. Now the opposite is true, right? When you're losing, when you're wrong, you need to know when to get out as well to kind of limit your losses, right? So if today in risk management you're able to kind of manage this three element, you should be fine. Okay. So of course, there are of course finer details and little differences here and there on how people manages their risk. But if I give you a very general idea of what risk management really is, at the end of the day, it's about this three elements. Okay, you need to define your losses, limit it. Okay, know when to get out if you're making money, know when to get out if you're wrong and losing. Okay, and if you can do this three in a very disciplined and I would say systematic way, then you're fine, right? You're doing risk management pretty well. Okay, so I hope that's clear. Okay, so in terms of that, you can see that gives you an overarching picture of what the four trading pillars really are. Okay, and just now, the start of the webinar, we did mention, right? You do not need to kind of like use all of the pillars all the time. But I want to stress again, the important here is you want to have a very complete and holistic understanding of the market so that you have the power of choice. So just give you an example, right? This year itself in 2022, okay, a lot of central banks are actually talking about like tapering, rate hike, and things like that. Okay, so if you do not have a good understanding of what fundamentals are, what the macro analysis really is, you have no idea what all this is. Okay, so macros comes in. Okay, now sentiment analysis, just to give you the picture, right? We have like pandemic, the COVID situation started in 2020. Okay, going to 2021, and of course we have like what the Omicron and things like that. Okay, so if you're not aware of sentiment analysis, you have no idea how all these things affect the market. And if you look at it, whoa, why the price drop? You have no idea, right? You become panic, you get fearful, right? But with the understanding of sentiment, you become calm. You know that okay, if there's a pandemic, it creates uncertainty, it creates fear, and therefore there's a certain reaction that the market's gonna have, right? So that's sentiment. Of course, technical analysis comes in almost every day if you're doing active trading, right? Because you want to identify like where are the key levels to enter, to exit, which direction you want to primarily focus on, whether it's short term or long term, right? So technical analysis comes in almost all the time. Okay, and of course, risk management is where if you're executing a certain trade, you want to know, okay, the max loss I'm gonna have for this particular idea is this. Where do I get out? Where do I get out if I'm wrong? Where do I get out if I'm right? Okay. So I just want you to see every pillar here has its role, and it's important as a trader, okay, especially if you're looking at FX, to understand this four pillar. Go and master them, okay, and then from there build up your strategy. Okay, so your strategy can be maybe if I'm looking at long-term macro, it's more important. It's going to take a little bit more of a precedence versus the other analysis. If you're looking at short-term, maybe technical analysis is going to come in more handy. Okay. If you're looking at news, trading news, right, then maybe sentiment analysis will come in a little bit more handy. Right. So I hope, by giving you some kind of example like that, you can see why is it important to understand. Oh, because I always say, you want to gain back the power of choice. The more you know, the more tools that you have in your toolkit, the more options you can choose, right? And the more informed decision that you're going to be making. Yeah. So I hope that helps. Hope so far is clear. Okay, and that's what I really want to kind of share with you in this particular webinar over here, to give you the overarching understanding of what this four trading pillars really is. Okay, and hopefully I'm able to also inspire you to go and dig a little bit further, go and study a little bit more in depth into each of this pillar itself. Yeah. So that's all from me for today's sharing over here. I hope it helps, hope it clarifies certain things, hope it gives you some different perspective of the market as well. And all the best in your journey. And I'll see you guys real soon.